Hello. Good afternoon, Garima madam.
Hi, good afternoon, Pradeep. How are you?
I'm good. Thank you for coming on board here.
Sorry,
Thank you for coming on board. So,
I can't hear you, Pradeep, actually.
okay.
Am I audible to you?
Yeah, yeah.
Okay, now
You are
it's
audible.
better. Yeah, now it's better.
Okay. So I was just saying thank you for joining this webinar and
Mm.
accepting our invitation.
No, thank you so much for inviting me, Pradeep. Thank you so much. I guess we'll wait for some time and then start.
Actually, we can start because people will keep on joining. So, Kalpina madam, can we start now?
So can we wait for just 2 minutes?
Yeah, that's fine, Ananya. Let us know when you are ready.
Yes, sir, just 2 minutes. Welcome everyone for Impact Lecture Series 2 conducted by the Institute Innovation Council of Don Bosco Institute of Technology. I request Dr. Feroz Sheikh to introduce our speaker for today, Advocate Garima Mitra ma'am.
Good afternoon, all. Am I audible? Hello.
Yes, sir, you are audible.
Okay. Good afternoon, everyone. So, for today, we have a very eminent speaker, Miss Garima Mitra. So, let me introduce her. So, Garima Mitra, a lawyer by profession, is the co-founder of Tree Life Consulting, a firm which focuses on financial, legal, and compliance advisory services like IP registrations, fundraising documentation, valuations, ECOPs, contracts, and data protection. At Tree Life, Garima balances the twin responsibilities of running a business and leading the legal and compliance teams. She advises clients that range from startups to investors to fully matured businesses and has been a critical part of the journey of emerged startup like Clever Tap, White Hat Junior, Rentomozo, Social Alpha, and Sust Labs. She has been instrumental in developing highly effective legal framework for their organization. Garima also takes a keen interest in industry development and serves as an active speaker mentor at CII, that is Confederation of Indian Industry, also at UN Women and a host of such industry platform. So here I welcome Garima Mitra madam. Yeah.
Thank you, sir. I'm just going to share my screen. Please let me know if you all can see it. 1 second. Wait, are you able to see the screen?
Yes, sir.
Okay, great. I'm just going to make it full screen so that it's easier. Okay, great. So I'm just going to take you. So I think Feroz sir gave my brief and introduced me really well. Just a little bit about myself. I'm a lawyer by profession, and I advise startups and investors in the startup ecosystem. What we're going to do in today's session is basically going to understand how an idea can actually be built into a business, and then what all does the business actually require to keep running, and what is the life cycle of a typical startup, right? um, what we will do is I will try to cover everything in short breaks. I will pause for questions. If you have any questions, please put them in the comment box, or you all can ask me questions right at the end also. Uh, I will try and cover most of your questions into the session that I am holding. If anything sort of is not covered, then you all can obviously ask questions, and later on after the session also get in touch with me one on one, right? So moving on to where to actually begin, right? A lot of people have this have a thought that every startup you need to have an idea first, right? So now, whether the idea is solving a problem, or should it compulsorily solve a problem and be problem solving, is something that you need to figure out, right? So there are two schools of thoughts when it comes to startups. So one is that, startups have to compulsorily solve a problem, and the other school of thought is that the idea has to be there, and the problem or the requirement of that can actually be created, right? Now, to think about it, there are a lot of startups who are solving a problem, right? Now, when you talk about solving a problem, you can say, for example, there were no telephones, right? So the telephone companies were brought into the picture, or mobile phones, right? Mobile phones were manufactured, and those were solving a problem. Or say, for example, there are certain biotechnology solutions that are in the market, which solve a lot of problems that people face, right? Whereas when you go to think about it, there are also a lot of successful startups that have come up, which have created a need for the product. So, say for example, touch phones, right? When Apple brought out touch phones, there was no problem as such in order to have a touch phone, or that mobile devices were not used. Mobile devices were used, right? Mobile phones were used. But when Apple created that touch phone, everyone suddenly wanted, it created a need for a touch phone, right? Similarly, Amazon or Flipkart, it's not like you couldn't buy stuff in the brick and mortar place, but then the idea was such that the convenience that was offered then slowly actually created a market for these kind of products and for e-commerce portals. So when you are thinking about how do I start up, or what should I do, there are two ways to think about it. One, whether you're solving a problem, or whether you're creating an idea which is creating an industry on its own, right? there are two ways to look at it. There is no right answer to it on where to begin, but the idea is to understand that there are these ways, or there are these thought processes in the market, right? Now, moving forward to what a typical startup life cycle is all about, right? Um, a lot of people today feel that startup life is fancy. Startups are the new in thing to do, right? However, it's not a very easy process, right? We've always heard that entrepreneurs are very hardworking. Entrepreneurs, go through a lot of hardships in order to actually become successful. So when we are talking about any successful startup, right, there are a lot of things that are actually go behind making that startup successful, and these are the things that are often not talked about, right? They're not glorified, or they're not really given that much consideration. Now, when we're talking about a typical life cycle of a startup, right? A life cycle of a startup actually starts as soon as you have an idea. Now, how to take that idea? Yeah, so you may have an idea probably to sell baby products, right? Now, to sell baby products, what is required? How do you go about doing that? How do you launch the business? And once the business is launched, how do you keep running that business, right? And from running that business, how do you keep expanding? Now, these are the things that are required. So, to build a startup or to build a business, you need to have a sustainable model, right? Today, so gone are the days where startups were being funded for left, right, center for the innovation, right? However, now with innovation, sustainability is also a chapter that investors look for, or businesses are required to have the ability to sustain on their own, right? So when we talk about sustenance, it also means that every business is built on profit making, right? So the idea is that if you have a product, if you have a service, or if you feel that startups that you want to start up with your idea, that idea A has to generate income, right? Then needs to also have the ability to turn that idea into profits, right? The income should be enough to actually run your business and to help sustain the people that are running it, right? Now, COVID basically taught us that a lot of startups who did not place reliance on this requirement of creating profits, or the requirement of having a steady cash flow, uh, some could not really survive the pandemic, right? So, which is why it is important that no matter what happens, your business has to sort of be immune. And the way it is going to be immune is only when you build a model which is sustainable on its own without having to depend on a third party's money, right? Now, having said that, looking at a very, very typical life cycle of a startup, now the first stage is the idea stage. The idea stage is where you think about what to do, what not to do, and look for the for validation of your idea. Now, when you're looking for that validation, you're also looking for your target group. You're also looking for the customers that you want to acquire, what type of customers you want to acquire, how do you appeal to them, whether you appeal to them, what needs to change in your product, if at all, or if your product is fine, if you feel that the validation for your product is already in the market, then how do you go about doing that? All of that comes in the pre-incorporation stage, right? Then you go to the launch of business. Now, in launch of business, the first thing that comes to your mind is, what kind of entity do I need to build? whether I need to become a private limited, whether I need to become an LLP, a sole proprietor, whatever it is. Now, that's the first question that you have to answer in the launch of your business. Then happens that what are the various licenses that may be required to run my to launch my business. Now, once you're moving towards making a business, there's also there's a requirement that all businesses be conducted in the realm of the law, right? So you have to sort of function in the framework of the law and the regulatory requirements. So what kind of what all do you require to actually have a business? Those are the various licenses that you require. Now, once the decision has been made that this is the type of entity that I want to incorporate, from there on, these are the licenses that are going to be required. Then you can launch your business, right? Once your business is launched, that is the second stage of your business. Once the launch of business is done, then comes to running your business, right? Now, what are the things that you require to run your business? This is one of the toughest times of your business, and also the most exciting for an entrepreneur, right? So there are hundreds of things that are required, and there are a lot of moving parts that require to be molded in order for your business to run smoothly. Now, when I say running your business smoothly, it means that everything that needs to be in place has to be in place, right? So you have to have certain licenses in place. Now, whether the licenses are going to expire, whether they need, whether the government needs any reporting based on those licenses, whether from those licenses you want to have, say for example, any kind of returns that need to be filed, or there needs to be any reporting from there onwards. If there is any requirement of new contracts, whether you want to take in employees, you want to hire some freelancers, anything and everything goes into running your business. Payment of taxes, accounting, all of that, right? All of that is included in running your business. Then comes raising capital for expansion. This is the fancy part of your startup life cycle, right? It is about raising capital. Now, raising capital is also important. You need to understand from where you can raise capital, how to raise capital, and how much to raise, right? And this capital generally is raised only for expansion, correct? So when I talk about the life cycle of a startup and go through each of the stages, right? You cannot skip any of the stages, correct? You need to have an idea to actually launch your business, and you need to have already launched your business to run your business, and you already need to be having to run your business to actually raise your capital. You cannot go from an idea to raising capital directly, right? You cannot skip launch and running of your business. You need to have a proper protocol in terms of entity, in terms of showing usage of your product, to validation of your product, which will actually take you to the stage of raising capital, right? It cannot happen directly that, here's my idea, now give me money. That is not how the startup system operates, right? There needs to be a lot of planning, a lot of effort put into how you run your business to actually raise capital for expansion of your business, right? Now, moving on from here, right? Coming to the pre-incorporation stage. So what I'm going to do is we're going to see these 4 stages through what all maybe the challenges and what are the legal aspects that come into all the 4 stages of the startup life cycle, right? Does anyone have any questions till now? Please let me know. If not, then I'll move forward.
Hello.
Yeah.
You just mentioned now that for a startup, once it is established, then only you can raise money. But then in India, there are many VCs. They are giving seed fund for idea stage startups also.
Correct. So when you talk about seed stage, right, and idea stage, you cannot actually you cannot take the funding, right, which is at a pre-incorporation stage. You will still need to launch the business. You will still need to actually run the business. You will need an MVP to show. Without an MVP, there is no seed funding, right? Like today, if I'm building, say, a product, I cannot actually expect an investor to put in money without showing the utility of the product. I will always have to show the utility. There always has to be idea validation. Even these seed stage startups, right? Seed stage startups also, when and there are a lot of early stage funds that enter the company, they always look for actual MVPs, right? It cannot be an idea stage, cannot be in a way that you have an idea and there is no company and you're raising funds, right? It's not like that. You have to actually have an entity, you actually need to build a team. All of that is also required to raise capital. So even with idea stage startups, you still need to have a valid entity in place to raise funds. Anyone else? Great. So we'll move on. So moving on to the pre-incorporation stage, right? Now, pre-incorporation stage is that of idea validation, right? What you do is basically in this stage, validate your idea while you are capturing your learning. Now, how you do that is first you have a method in place, right? That best suits your MVP. Now, maybe you have a focus group, maybe you talk to friends and family, or maybe you have a product which has to basically be tested, right? Now, when you test this product, it is very, very important to test it with your TG, right? So when I talk about TG, it means target group. Say, for example, you are looking for, or you have an idea to sell baby products, like I discussed further before. So with baby products, now your target group, right, is not babies. Your target group is actually mothers and parents of babies, right, depending on what is the age of the baby. So say, for example, if you are doing baby products for newborn babies to 3 years, 3 year olds, right, at that point of time, your target group is going to be the mothers and the parents, the grandparents, maybe pediatricians and things, and people like that. Whereas if you are going to look at if you are going to look at products which are for kids of around, say, 7 to 10 years, right? At that point of time, your target group is going to change from just parents to parents and children, right? Whereas when you're going to sell something, say, for example, teenagers, right? Or let's see, not even teenagers, for people, for younger generation who's above 18, right, or is just going to become 18. At that point of time, your target group moves completely to the students or to the kids and not to the parents, right? So you, to evaluate your product, you also need to understand who your target group is, right? And only they have to, and they can validate whether your idea is working or not, right? So say, for example, today, just because I now when you're selling baby products, if you don't go to a parent and if you go to some random person who doesn't have kids, they like the idea, that is not idea validation. A person who actually has babies and who is going to have utility of your product is your actual target group, and that is the person who can validate your product or your idea. So it is very, very important to reach out to your target group. Only then your MVP can actually be made, right? Now, your idea plus the testing, right? Taking the feedback from the test, right, of your or your validation, and molding your product based on the feedback that you have received from the market actually brings you to making your MVP, right? Well, MVP is a minimum viable product. That is the MVP, or that is the product that can actually go to market, right? What you create and what you test in the market, the feedback that you get, and the implementation of the feedback to your original product actually leads you to your MVP. That is when you are in a place where you can actually launch your idea, right? Of course, even after the MVP, there are a lot of changes that actually happen, because this was a small group testing that you may have done, right? Moving forward, when people start using your product, when you go to the market, when you talk to vendors, when you talk to consumers, when the consumers actually use it, a lot of these learnings are also they're also multiplied, right? And it's a very famous saying that if there is not a 90% change in your first product and your current product, then you're doing something wrong, right? So you have to launch very quickly. You can't keep dragging yourself and testing your product to the limit that you want to perfect it, because there are going to be changes that the market practices bring about. So the idea is to take rational decisions. The idea is to be focused, be rational, and be fast, right? Because of the startup ecosystem being so fast paced, you need to have all three of them intact, right? Everything moves in parallel. So speed, rationality, and functionality of your product have to actually work hand in hand together, right? And that's how you grow and progress in terms of from your MVP to the product that you're selling at any given point of time, right? So today what you're doing is going to should actually differ widely from what you're doing 4 years down the line, and then similarly another 4 years down the line, right? The businesses have to keep innovating. Businesses have to keep making changes based on the market conditions. Now, coming to your second point, right, on launch of business, right? Now, broadly, right, businesses are categorized into two sort of buckets. One is a product, and second is a service, right? A product is anything that can work without the founders, whereas a service is something that cannot work without the founders. Okay, to give you an example, Uber, right? Whether it's a product or a service, yeah. Now, Uber is a product, right? When I say Uber is a product, I do not mean that Uber is not giving us services. Yes, it is giving services, but the service, right, is the platform that you're using. So the platform is the product, right? Whereas when you look at a lawyer, or when you look at, say, Tree Life, for example, Tree Life would be categorized as a services business. Why? Because as a lawyer, I'm providing legal services to the customers, right? So tomorrow, if I am not available to give the services, the company is not going to move, right? Whereas in Uber, right, till the time the software is working, everything is hunky-dory. No one is bothered about who the CEO is, right? Or who is actually giving the service. It is the platform that you are bothered about. So that is the clean distinction between product and services, right? Now, all your tech products, like, say, for example, Amazon, Apple, then Flipkart, all your edutech platforms are all product companies, right? Any kind of services like advertising services, legal services, all of the chartered accountancy services, all of these are basically defined, or they go into the services bucket, right? Now, once this distinction is determined, right, when you launch your business and how to make the decision of whether I should make a private limited company or an LLP, you need to ask yourself a question: is your business fundable, right? Now, how to answer that question whether your business is fundable or not, right, is to determine whether you fall into the product category or the service category, right? Now, if you fall into the service category, right, then the best way to move forward is that you can become an LLP, and and your business is not fundable, right? When I say it's not fundable, it does not mean that you cannot hold in your own money, but a third party investor is not going to invest in your company, right, or in your LLP. And when I say that a third party investor is not going to do that, is because if you stop giving your services, if you are no longer a part of that LLP in which the investors have invested, then the investors do not get a return on their investment, because they're investing in your ability to provide services, right? So today, if out of Tree Life, if say me and my co-founder are not working, then the value of the company doesn't really work, right? Which is why a third party investor is not investing in the company. Whereas coming to a product company, right, when there is a product in your company, your business is fundable. Why? Because today, when I gave you an example of Uber, the platform is going to keep working, right? The platform is the intellectual property of the company, and the investors are investing on that platform. So whether the CEO is there, whether the founder is there, they're not bothered till the time the platform keeps working, right? It is not very people centric, it is software centric. Okay. So that's the difference. And that is when your business actually becomes fundable, right? Now, a product company is more on the side of wealth generation rather than income generation, right? So the return is given on the entire company after a really long time, right? And the wealth is generated in terms of the valuation of the company moving forward. Whereas in a service company, you give legal services, you give advertising services, and you get paid, right? So it's fast cash. So income generation is very, very quick. So which is why you don't even need that investment in the first place, right? Whereas in a product company, there's a lot of R&D, lot of tech development, which requires a lot of money, which requires investment, right? So in a nutshell, if you're a product company and if you're going to require fundraising in the future, then you should go for a private limited company. However, if you are giving services and will not require to raise funds in the future, then you should make an LLP. Now coming to forms of entity, right? Now, we determine difference between when a private limited company and when an LLP. You may also have heard about sole proprietorships, partnership forms, and things like that, right? What we do is we're going to understand what are these forms of entities and when they're actually used, right? Now, sole proprietor is the easiest formation of a company, a business, right? A sole proprietorship is nothing but a corporate entity of a single person, right? So today you hold a PAN card, and that same PAN card will have a commercial name. So, say for example, it will be ABC proprietorship, or say Tree Life, or say XYZ, right? Anything. Now, this sole proprietorship is, like I said, nothing but a corporatization or a business name for yourself, right? So the tax is paid by the person who forms the sole proprietorship on the same PAN number. Okay. Now, sole proprietorship is easy to formulate. All you need to do is open a bank account in the name of the business and you can start operating, right, under that name. When it is used at the time of validating your idea, right? Like, say for example, I want to sell some baby products and you don't want to sell it on your own name, then you create a bank account for your baby products and then start selling under that brand name, and you get money in that brand name also, right? However, you cannot get fundraising like that in a sole proprietorship. Then which is why it's only used at the time of pre-incorporation or at the time of idea validation. Coming to partnership form, right? So partnership form is generally used between family members or close friends, because partnership form is a very old type of entity that has been formed, right? So partnership form is where two or more people actually come together to share profits and losses. They don't have equity; they share profits or losses, right? Now, in a partnership form, there is a very big downside that your personal assets of the partner can be attached when there is a liability on the partnership form. Although it is a different entity from the people who are running it, it still bears a lot of responsibility on the partners because of the attachment of personal assets, which is why partnership form is not the preferred choice for a lot of people. And generally, a lot of old family run businesses were are carried out under under partnership forms, because at that time the partnership form was the only convenient way to start a business. Now coming to a private limited company, as already discussed, when you need to raise funds externally, a private limited company is the best way to move forward. A private limited company is where your liability is limited, right? Now it is limited to the extent of the capital that you put in, right? Now, for the capital that you put in, you also own a part of that company. So a part of the assets are owned by you, correct? And now, a limited liability partnership is a marriage between a partnership firm and the private limited company, right? It is easy to make. It is where the partners come together to share profits and losses, but your personal assets cannot be attached in an LLP, right? Because the liability is limited, which is why a lot of people go and incorporate in LLP. Now, the liability is limited both in LLP and in private limited company, right? And LLP is just easier and, however, does not satisfy the requirement of raising funds. So, if you want to raise funds, then LLP is not the answer, because you will not be able to do that in an LLP, right? You can do that only in a private limited company, whereas in a service business, LLP is something that can be looked at. Any questions till now? We'll take, I'll pause here. If you have any questions till now, I'm happy to answer. Great. Okay. So I'll move forward. Moving forward to running your business, right? Now, while you're running your business, there are three major things that come up apart from the actual business that is, or apart from the actual service that is being given, or the product that is being given, right? Three things are legal, compliance, and finance. Now, in legal, there are certain documents that need to be signed. Compliance is basically ROC filing, any kind of financial returns that need to be put in, and under finance, the various actions that need to be taken by the company, right? I'm going to run you quickly through what the legal essential documents are, what is the compliance, and what requirements in the finance side are there for a company.
Excuse me, ma'am.
Yeah, tell me.
Yeah, the slides are not visible.
They're not visible?
Yes.
One second. Are you guys able to see now?
Yes, yes.
Okay, great. All right. Just give me a moment, 1 second. Hi, sorry. Are you guys able to see the slides now? Hello?
Screen is not shared.
Share. 1 second. Now is it visible?
Yes.
Okay. All right, great. Okay. Now moving to, like I said, that in running your business, there's legal, compliance, and finance, right? Now coming to legal, there are various documents. Compliance are the various returns that need to be filled in, and finance are the actions, like say accounting, then calculation of TDS and things like that. Now going on to the legal essential documents, right? What are the various legal documents that need to be basically entered into for a company to run their business, right? First of all is a co-founders agreement. A co-founders agreement is nothing but an arrangement between co-founders who are running a business, right? So today you may be a single founder, or you may have 2 or 3 co-founders, right? What is the arrangement between these 3 people or 2 people while running the business is very, very important, right? So you need to have transparency amongst co-founders, that what are the roles and responsibilities, what is the split of the equity. All of that needs to be understood and be given in the co-founders agreement. Then comes the MOA and the AOA, right? Memorandum of Association and Articles of Association. An MOA is nothing but a private limited company's document to define business objectives of the company, right? From there is Articles of Association, which is the bylaws of the company, which basically how the shares are going to be transferred, what is going to be the requirement of a director, how can a director resign, how can a director be appointed. All of these things are given in the Articles of Association. Now coming to non-disclosure agreement. Non-disclosure agreement is an NDA. You all must have heard a lot about this, right? An NDA is basically signed to maintain confidentiality and to safeguard your ideas from third parties. Correct. So, say for example, if I'm sharing something which is very, very important to my business, right, with a third party that I don't trust and that I don't know, what I do is I sign a non-disclosure agreement with that person so that I'm able to talk freely to them, right? So it may be a vendor, it may be an investor, anyone, right? So anytime when you feel that confidential information needs to be protected, non-disclosure agreement is signed for a business. Then comes employment contracts, freelancer contracts. Employment contract is nothing but a contract that you sign with your employees, right? So this should cover generally confidentiality, that whatever information that is gathered by the employee should be kept confidential. Then the employee cannot sort of solicit any clients of the company or other employees of the company when they're leaving. Then there's a non-compete aspect that needs to be put in. Then intellectual property needs to be put in. All of these things come in the employment agreement and the freelancer contract also, right? Employment contract is with employees, freelancer contract is with the freelancers that the company hires. Then coming to developer agreement, right? Now, a lot of times when businesses are formed, at that point of time, businesses won't have an in-house tech team, right? So you generally outsource your logo designing, your website designing, app development, all of this, right? However, in India, whoever designs or makes a logo or makes a website, they have the right to that tangible product, right? So they need to actually waive their intellectual property right to the company. Now, this is very important. This happens through an agreement, right? And which is why a developer agreement covers all of this and is required to basically safeguard the interest of the company, right? Now, moving to privacy policy and terms and conditions. Now, privacy policy and terms and conditions is something that a lot of us have signed as users as well, right? What is that? Now, privacy policy is mandatory under the law, right? Any company, any business that collects data or personal information of a person needs to make a privacy policy in which they determine what data is captured, how it is captured, how it is stored, and how it is used, right? Without that, you are flouting the law. Terms and conditions. Now, terms and conditions are basically the document that governs your relationship or the business's relationship with its customers, right? Now, say for example, you get a faulty product from Amazon. What's the first thing that you do? You go check the terms and conditions to see what are the remedies that you have, what actions can be taken against the seller, and things like that, right? So when you are ordering from Amazon, you have accepted the terms and conditions, and hence it becomes a valid contract. Similarly, when someone is doing a startup and they have their customers, they also that business also needs terms and conditions with their customers, right? This is very, very important. Privacy policy and terms and conditions are one of the most important document when you're running your business. Then the second part comes to intellectual property rights. Now, intellectual property rights are nothing but what is generated out of your intellect, right? Now, when you're making tech, when you're making a product, or when you're giving any service, what you're selling is invariably intellectual property, right? Now, if there is something completely new and has industrial application, it can be patented. Now, patents have to be applied for before you go to the market, right? So this has to, so patents in fact have to be before the launch of the product, right? So that no one can actually copy you. Now, patent is applicable only in scientific or sort of inventions that are done but have industrial application, right? And you have to be one of the few people to have done it, and it should be a novel concept. Then coming to copyrights, anything that can be published can be copyrighted, be it a story, be it a photograph, be it a film, things like that can be copyrighted, right? However, in India, copyright is an inherent right of the person who has created that intellectual property, right? So if I click a photo, then that is my intellectual property till the time I actually waive it off or assign it to the business, right? Now, how that happens is through the developer agreement. So copyrights is not necessarily required to be registered. However, if you need some extra protection, registration is available. Then coming to trademark, this is the most popular form of your intellectual property. Any brand name, any logo, and things like that can be trademarked. So if I have a brand name called Tree Life, right? So Tree Life is something that needs to be trademarked, correct? Then if there is a slogan can be trademarked. A logo can be trademarked. The name Tree Life can be trademarked, right? That basically is determined, and that requires protection, and a registration of a trademark is very, very important, because otherwise someone else can actually make a similar product with similar name and can use it and use the name, right? So your name is your identity, and the protection to that is through a trademark application. Now coming to various finance compliances, right? So I'm not going to go too much into detail here. What we're going to do is just figure out these are the type of things that are required. So GST registration is required, then TDS deduction is required, income tax returns have to be filed, profession tax is another requirement for businesses, right? So if you have employees, you need to deduct profession tax, pay it to the government on their behalf. Then comes shops and establishment license. No entity can operate in Maharashtra without a Gumasta license or a shops and establishment license, right? This license is basically given by the BMC to and basically to monitor businesses and or commercial establishments, right? So the idea is to get that, which is very, very important. Then there are various other compliances like labor compliances, right? So provident fund, then ESIC, labor welfare fund, all of these. So labor compliances actually come into picture when you have a minimum number of employees like 10 or 20 and so on and so forth, right? Not right at the beginning. So however, you need to know that, you know, these are various things that can actually crop up in a business, right? Say for example, GST. Now, you may not be under the 20 lakh turnover limit, right? But you have vendors who require GST registration. You pay a lot of GST, so taking credit should be easier and things like that. that enables, so the GST registration enables that. So for in running your business, you will first need to get the number, then also need to file returns every month, right? So that is one thing. Second is TDS, any payment made by businesses. Businesses are bound to deduct an amount or deduct tax at source, right? Which has to be paid to the government on behalf of the other people, right? This is one of the major requirements in finance, the deduction of TDS, right? Then comes income tax returns. We all know how important it is. Profession taxes for employees and shops and establishment, like I said again, is by the BMC for any and all commercial establishments. Now coming to running your business with compliance, right? Now in compliance, what I've covered is only private limited companies, sort of filings. For LLP also, I'll let you know what it is in the workshop only. So there are various forms that need to be filed on the MCA website. So MCA is the Ministry of Corporate Affairs, and ROC is the registrar of companies, who is the regulator of private limited companies and LLPs, right? So what happens is that after certain intervals, based on certain deadlines, businesses who are LLPs or private limited companies need to file certain forms with the ROC, right? Now, one is the foremost, and which is very important, is the DIR3 KYC. Any company needs directors, any LLP needs partners, right? The partners and the directors have to verify their details with the Ministry of Corporate Affairs every year through a form called DIR3 KYC. Then comes AOC 4, NGT 9. These are basically financial statements of a private limited company that are filed with the ROC. Now, similarly, there's Form 8 and Form 11 for LLP also. Same things happen, financial statements are submitted. And then comes statutory audit, right? Every company, right? Every private limited company compulsorily needs to go through statutory audit. LLP does not require statutory audit, but a private limited company requires statutory audit. So that needs to be done. Then there are various resolutions that are passed in a private limited company. In that scenario, MGT 14 is filed. Then if you're taking any kind of loan, or if you're, say, for example, you have any outstanding to any MSMEs as a business, then you have to file an MSME 1 form. Then there is various forms called BEN forms, which are used for reporting of beneficial interest in the company. These are very ancillary forms. The main ones are, of course, the DIR3 KYC and the AOC MGT 9, right? Now, coming to the last thing. So running your business was one of the most tedious processes, and like I said, there are a lot of moving parts, right, in running your business. Now, these moving parts generally are, along with your business, are also legal, finance, and compliance, which needs to be adhered to. A lot of founders completely ignore legal, compliance, and finance requirements, and then have to pay a lot of penalty to actually regularize these filings, right? So at that point of time in the business, when you feel that, if this is costing me slightly more, trust me, if you are non-compliant, in the next 2 years, it's going to cost you a lot more than what it was costing 2 years back, right? So it's very, very important that regulators be paid taxes, returns are filed, and things are moving smoothly to ensure that you don't pay a lot of penalty in the future. Now, coming to, like I said, the fancy part of the startup life cycle, that is raising capital, right? This is a typical, very, very typical flow of how things work while you are raising capital, right? I'm just going to put this here for 2 minutes. So the first action is to pitch to the investors, right? Once you pitch to the investors, then there are two possibilities. One, that they like you, I like the business. And second is that they pass, right? If they like the business and they want to invest, then they give you a term sheet. A term sheet is nothing but a letter of intent. Now, once that is signed, there are three parallel processes that take place, right? So, first is due diligence, second is the regulatory compliance, and third is the investment agreements. So, just because the investors have liked your business does not mean that they're going to just cut a check and give you, right? So, it doesn't work the way Shark Tank portrays it, that this is your check and ye raha aapka investment. It does not work like that, right? It Once the pitch is done, then the term sheet is signed, right? From the term sheet, there are three things that happen, three parallel processes. First is a due diligence, right? Due diligence is where the company is scrutinized by the investors, lawyers, and chartered accountants to see what is happening, right, in the company. They look at all the documents signed, they look at all the filings, all the returns, all the licenses that are required to say all the GST returns, TDS returns, whether income tax is being paid or not, whether those DI3 KYC is being done or not, all of that, all those things are seen in the due diligence, right? And this is an exhaustive affair in terms of understanding what can be done, what cannot be done, right? Then comes regulatory compliance. Now, with due diligence, there is also a requirement that the company be ready to take the infusion of money that is going to come in, right? To do that, there are certain filings that need to be made with the Ministry of Corporate Affairs website. Now, that regulatory compliance also has to be started by the company. Parallelly, the third process is the investment agreements. Now, investment agreements are basically a detailed version of the term sheet, right? This determines what the rights and responsibilities of the parties are going to be and are negotiated heavily, right? After these three things fall into place, only then can the transaction actually go towards closure and the actual money is realized into the bank account of a company, right? Now, understanding quickly the types of investment agreements, right? Term sheet. A term sheet, like I said, was a letter of intent where brief terms of the investment are put in, right? This is a non-binding document. Now, the investor basically says that, this is the valuation, this is the percentage of equity that I'm going to hold, then whether you can transfer shares, whether shares are locked in, all of that goes into the term sheet, right? Then comes the share subscription agreement. A share subscription agreement is basically the terms on which the investor is going to subscribe to the shares. So those are the terms on which the investors are going to buy shares of your company. In the share subscription agreement, the investors take up the obligation to invest in your company, right? So this has basically terms of price of the share, what is the date on which they're going to put in the money, what is the type of instrument that they're going to use, things like that, right? Then comes shareholders agreements. Shareholders agreements is basically between all the shareholders of the company. So maybe you're raising a second round or the first round. Shareholders agreement is the Bible of your company, right? It has detailed out all the rights and liabilities of the shareholders of your company, and is signed by everyone, right? All the founders, the company, the existing investors, the new investors, all of them sign the shareholders agreement. So basically, when we were talking about what are the various legal documents, right? At that point of time, I had said that, an articles of association, an AOA of the company is a Bible of the company. It determines how you can transfer shares, how the directors can be appointed, and things like that. All of those topics are discussed and laid out in the shareholders agreement vis-a-vis your relationship with the investor. Now coming to share purchase agreement. Share purchase agreement basically comes into the picture when there is a sale of shares from one party to another, right? A shareholders agreement or a share subscription agreement is generally entered into when there is a new investment coming in into the company. A share purchase agreement is when the shares are transferred. So say for example, there is one investor who wants to exit and there's another investor who's coming into the company. At that point of time, that first existing investor can sell shares to the next investor, right? There the money doesn't come in the company, the money goes to the existing investor. That's when share purchase agreement is signed. Now coming to types of instrument, right? Types of instrument that are basically used in investments nowadays. First is the equity shares, and that has all voting rights, is the common stock of the company, and is used and is generally held by the founders as well. Then comes to compulsorily convertible preference shares. Now, compulsory convertible preference shares are preference shares who have limited voting rights and have a preference in liquidity as opposed to have a preference in liquidation as opposed to equity shares, right? So CCPS are the most popular form of investments. All investors who invest in companies are generally investing under CCPS, right? So they hold compulsorily convertible preference shares. Then comes compulsorily convertible debentures. Now, this is also similar to preference shares, but they are debt, right? So it's only quasi-equity. This is primarily used when you're raising a bridge round, which is like, you want to, from a pre-series A to series A, between that you want to have some kind of a bridge funding where you need a little bit of money. That's when you do compulsorily convertible debentures. And then comes convertible notes, right? Convertible notes are something that are a new, relatively new instrument, right? They're a short-term debt and a hybrid security. So this is an actual loan that is given to the company by the investors, which can be converted into equity, right? Now, this, however, has certain caveats, right? So a company needs to be registered under the Startup India program to actually issue convertible notes. So it needs to be a recognized startup under the DPIIT scheme, and any tranche that is given to the company for a convertible note cannot be less than 25 lakhs. So it needs to, so the amount of investment per person has to be 25 lakhs or more, and this has to come in a single tranche. So it cannot be like 12 lakh and then 5 lakhs. It needs to be 25 lakhs at a go or higher, only then, right? Then comes, like I said, the convertible notes are required for startup, can be done only by registered startups. Now, a very, very popular question that we get is, how much to dilute, how should we dilute our company and things like that. So there are various rounds of funding that take place. The first round is always friends and family sometimes, most of the times, because if your friends and your family do not invest in you, then you cannot expect a third party to invest in your company, right? At this point of time, the dilution is between 15 to 20%, and the quantum of money is from 5 lakhs to 25 lakhs now rather than 10 lakhs, right? And this is at a very initial stage, right? This is almost like in your launch of business time. Then comes seed and angel round. Here, the dilution goes up to 20%, and the quantum for the same is almost up to 1 crore or more than that, right? And this is where probably early stage startups, early stage investors also come in, and the quantum is slightly higher for them, so it can also go up to 5 crores nowadays. But of course, dilution is anywhere between 20 to 20% to 22%. Then comes Series A, which causes a dilution of anywhere between 20 to 30%, and the quantum can go up to, like, say, anywhere from 4 crores to like 20 crores now, right? It can also, we've also seen rounds that are like probably almost touching 22, 25 crores, which are categorized as Series A. So anything that is basically after your angel round generally is categorized as Series A. This is generally to scale up your business. So Series A funding comes only once there is the initial setup is done. After the initial setup, you have users that are determining how the business is growing, and then you raise Series A, right? After Series A, when you basically go on and so forth, the Series B, Series C, it completely depends on your business needs and how you want to scale up your business further. Now, this is almost the last leg of, not almost, this is the last leg of the workshop. So there's pre-money and post-money valuation. This is one of the very key concepts of investment, right? So pre-money and post-money valuations are these jargons that are thrown very, very commonly, and not a lot of people understand what this is going to be, right? And what this actually means. Now, pre-money valuation is nothing but the value of your company, which is generally mutually agreed upon between the investors and the founders, and it is alternatively called as the value of the company as on date, right? So today, the valuation of your company, what it is going to be, is actually the pre-money valuation. The post-money valuation is the value of the company after it receives the investment amount. So it means that today, if the pre-money valuation is, say, for example, 5 crores, and you're going to get 1 crore rupees as investment, then the post-money valuation is going to be 6 crores, right? So pre-money plus investment is equal to post-money valuation. That is the simple concept of pre-money and post-money valuation, right? With this, I'm going to end the session, right? Because the life cycle of the startup is completed. If you guys have any further questions, happy to take questions now. We have, I think, around 15 minutes that we can probably discuss. Any doubts that you guys have, happy to answer.
Guys, you can ask her questions if you have any.
You can either put them on the chat or also just unmute yourself and ask questions.
Well, thank you, Garima, for your detailed account of what is the, what do you say, the life cycle of a startup and what are the legal aspects of that. I have a few questions. Okay, so
Sure,
can
please
you,
go
can
ahead.
you just throw light on what is an MVP once again? Means from idea to MVP, what are the steps involved in that? And when we can call that product as MVP?
So, like I said, right, from an idea, once you create a prototype or once you have a sort of a benchmark, right, then you go to the market, or then you go to your target group to actually validate the product or to validate the prototype, right? And after the validation, you get certain feedback or certain improvements that are done to your product or your service. And once that is done, then you get the MVP. Because an MVP is basically the minimum viable product, which means that it is something that needs to go, which is the with the least amount of effort which is gone to the product. That is your that's the MVP, right? And which requires, however, that is the basic product, correct? That is the most basic product that goes to the market. That is MVP.
Yeah. So in simple words, a prototype which is tested with a target group.
Correct.
Yeah.
Yes.
In real market.
Correct. In real market.
Okay. Okay. My next question is about you mentioned about the convertible notes, right?
Correct. Yes.
Are they similar to what something called as safe notes?
So safe
Or
note is not a security. It's not a loan. It is actually safe note. Safe is actually an agreement, right? So safe is the an agreement for future equity, right? Now, safe notes are basically not a loan. Convertible notes are loans, and safe is something that cannot be given in India. So, to counter that, we have convertible notes in India. Safe is a very American concept, and generally, Y Combinator uses that instrument. However, in India, safe is not under the regulatory authority to be given.
but I think there is something called as 100x VC. They have launched safe notes sometime back.
So 100x VC basically has named it as iSafe, but they actually take CCPS instrument. They just call it iSafe, but they take CCPS.
What is CCPS?
It is compulsory convertible preference shares.
Okay, so it is another form of convertible share.
Preference shares only. Yes, yes. They just call it iSafe.
Can you just
It's not
throw
a
more
safe.
light on their safe note, which is promoted by 100x VC?
So 100x VC, so see, that is the agreement that they have, right? But the actual instrument that is there is a preference share. So it means that if I'm going to buy that preference share at a certain price, then that is going to convert into equity share at a later point of time. So CCPS, like I said, it's a compulsory convertible preference share. A preference share is something that has priority in liquidation as opposed to equity share, and is compulsorily convertible into equity share later on. So in 20 years, it is converted into equity shares.
So suppose a particular company takes safe note.
Hmm.
By chance, there is no because there is no guarantee of real the goals, no, in startup phase.
There's no guarantee of.
Like that is the idea stage startup,
Hmm.
and you take a safe note, for example,
Hmm.
and then the targets or goals are not realized
Hmm.
because the investor is investing with the future prospect.
Correct.
Right? But then suppose there are possibilities the targets may not be realized really.
Correct.
So what happens to the money taken for developing or what do you say by the startup as from the investor in that
So,
situation?
fundraising in startup ecosystem is basically that when they give the money, they get shares of the company, right? So they own that much percentage of the company. Think about it like the share market, right? So today, if you're buying shares of say Reliance for 300 rupees, and if the market crashes and it goes down to 100 rupees, that 200 rupees loss is not borne by Reliance, right? They're not going to come and give you as a shareholder the 200 rupees loss that you've faced. So it is similar like that in the startup ecosystem also. once the money is in the company and the investors get the shares for it, then the company is utilized by the money is utilized by the company for its day-to-day requirements, business, and running the business and things like that. And if certain milestones are not reached or business is not booming as expected, then that money, unless and until, of course, there's some fraud that is done, but has been utilized for the business needs, no one can actually question it.
Okay, thank you. One more question from my side.
Sure.
Yeah. So you mentioned so many compliances, legal aspects, and all those things.
Right.
To register a startup and then running of the. Let us look at registration of a startup.
Hmm.
So, what is the typical cost involved while just registering a startup?
So for a private limited company or an LLP, the cost actually really varies, right? So I mean, if you go to India filings and stuff, you can get it for as low as like 7,000, 8,000 rupees.
Okay, fine. And just last question. There is something called as DIN. No? You need to register for.
Yeah, so that DIC KYC that I was saying, the DIN is a director identification number. It's a part of the incorporation process only.
Okay, it can be acquired by anybody,
It
even
can be acquired by anybody who is 18 years and above.
Okay. So that's all from my side. My questions. Thank you for clearing these questions.
No problem.
Yeah, Ananya, if there are other questions, you can go ahead. Otherwise, we can go ahead with vote of thanks and closing this session.
Yes, sir. So if there are no more questions, I request Ehtesham Siddiqui to propose the vote of thanks for today.
Okay, so yeah, I would like to thank our speaker for the day, Garima Mitra ma'am, for sharing such valuable insights about the startup ecosystem, and also the management for giving us permissions to conduct the session. I would further like to thank student technical team and Ananya, Jason, and also technical coordinators. The ESL core team. Also, I would like to thank you all for being such a wonderful audience. But please, before leaving, please put on the cameras so we could have a snapshot. Thank you, ma'am. Thank you, everyone.
Thank you.
Yeah. So, thank you. We can close the meeting now. Thanks.
Thank you for joining today's session and have a great day.